From the outside, China's rise is often explained through cheap labor, massive factories, and endless production lines. However, this perspective is both overly simplistic and incomplete, because the true driving force behind China's transformation into a global economic power lies not in what is immediately visible, but in a set of financial choices deeply embedded within the system itself. These choices were not designed to create sudden leaps, but to maintain control over the long term. The Chinese model prioritizes centrally determining the direction, speed, and areas of capital concentration rather than maximizing short-term profits. Instead of releasing money freely, the state disciplines its flow. It treats financial expansion not as a stimulus tool, but as a strategic lever. As a result, the Chinese economy grows without fragmenting at the same time. Risks are not ignored, but layered and managed systematically. What initially appears to be a complex structure is, in reality, a consistent answer to a single question: who should control money? China's answer to this question is remarkably clear. There is a market, but its boundaries are defined. There are banks, but their direction is not free. There is investment, but it is not random. This approach has transformed China's growth from a coincidence into a planned outcome. Yet this system also carries an unseen cost and fragile pressure points that require constant fine-tuning. So how exactly does this control mechanism operate? And why has it managed to endure for years without falling apart? One of the most critical pillars sustaining China's financial system is undoubtedly its banking structure. And this structure deliberately diverges from classical free market logic. In China, banks are not merely profit-seeking institutions. They are also instruments that guide the economy. Credit is not treated as a mechanism where risk is freely dispersed, but as a controlled resource channeled toward areas prioritized by the state. For this reason, the lending appetite of major Chinese banks is shaped not by market fluctuations, but by long-term national objectives: infrastructure, export capacity, strategic technology, and industrial clusters naturally become the primary recipients of these loans. This approach has allowed even projects that initially appear inefficient in the short term to transform into the backbone of the system over time. Investments that are often left unfunded in Western financial systems because they do not generate immediate profit have been patiently supported in China. The logic behind this is clear. Capital should not circulate rapidly, chasing returns as if in a race. It should concentrate in the right place at the right time. In this way, even if China has not entirely eliminated credit bubbles, it has largely succeeded in preventing the chain reactions that cause systemic collapse when those bubbles burst. Yet, like any model, this one is not flawless and carries a side effect. Inefficient companies can survive for long periods, and debt can accumulate invisibly within the system. Stability, therefore, requires constant recalibration. This is why China's banking system functions not as an engine, but as a steering wheel. It determines direction rather than speed. But is this guiding power achieved solely through banks? Or has monetary policy itself become an integral part of this structure? For China, monetary policy has never been a passive tool that merely gauges market sentiment through interest rates. It has functioned as a multi-layered control mechanism capable of direct intervention. The central bank does not adjust liquidity solely by looking at inflation or growth figures. It opens or tightens the flow of money based on which sectors should accelerate and which should cool down. For this reason, even when money is abundant in China, this abundance does not apply equally to every sector or segment of the economy. Liquidity is distributed selectively, and this selectivity operates within the system as an invisible insurance for financial stability. When necessary, banks are provided with targeted funding. When required, specific credit channels are quietly narrowed. Interest rates cease to be a signal on their own and are used, together with reserve requirements, temporary restrictions on shadow banking, and administrative guidance. This approach allows the Chinese economy to experience controlled slowdowns, rather than sudden breaks during global shocks. However, this flexibility also demands constant vigilance. If liquidity accumulates in the wrong places, pressure builds beneath markets that appear calm on the surface. The Chinese model accepts this risk and continues as long as it remains manageable. The core idea here is simple. When money circulates freely, it accelerates. When it is controlled, it is directed. China associates growth not with speed, but with direction. This is why monetary policy functions not as an emergency brake, but as a continuously adjusted balancing lever. But with such tight internal control, how has China managed to balance its trade and exchange rate policies with the outside world? And how does this system function when it comes into contact with global markets? China's rise in the global economy has not been determined solely by its production capacity. The delicate balance it established through exchange rate and trade policies has also played a highly significant role in this ascent. China recognized early on that fully liberalizing its currency might be appealing in the short term, but would create fragility in the long run. Thanks to this awareness, exchange rate policy was not treated as a variable left at the mercy of the market, but as a strategic tool designed to preserve competitiveness. The currency was neither allowed to become excessively strong nor weakened in an uncontrolled manner. The objective was clear: to sustain exports, protect producers from sudden shocks, and create a buffer against fluctuations in global demand. Through this approach, Chinese companies were able to maintain their price advantage for many years and became indispensable links in global supply chains. Trade surpluses, meanwhile, were not spent randomly. Foreign exchange reserves were accumulated to strengthen the system's resilience against external crises. These reserves functioned not only as a safety cushion, but also as a source of bargaining power. As a result, China rose not as a fragile producer in global markets, but as an actor capable of negotiating terms. However, this strategy was not always welcomed positively by the outside world. Exchange rate and trade policies were frequently criticized and even led to tensions. China, however, has regarded these criticisms as the inevitable cost of growth. Because for China, the priority has never been global approval, but the preservation of internal stability. Yet while stability was maintained domestically, what kinds of behavioral patterns did this model create for individuals and companies? How were saving, investment, and perceptions of risk shaped? Let us try to understand this in the next chapter. One of the most important elements sustaining China's economic structure, often overlooked yet fundamental to the entire system, is the financial behavior of society itself. In China, saving is not merely an individual choice. It is a natural extension of the economic order. Households have developed the habit of saving a significant portion of their income rather than consuming it. Behind this behavior lie not only cultural reflexes, but also the limited social security structure offered by the system. Individuals make sacrifices today in order to secure their future. These savings return to the economy through the banking system and are used to finance long-term investments. As a result, China's capital base relies not only on external sources, but also on a quietly accumulated internal strength drawn from its own population. When it comes to investment behavior, a different kind of discipline emerges. Chinese companies aim not for rapid gains, but for measured returns. A year without profit does not signify failure for the system. What matters is the strengthening of strategic position. This approach reshapes the perception of risk. Risk is taken but not recklessly. It is assumed within boundaries set by the state and in service of long-term Objectives. Individuals and companies do not change direction with every market fluctuation. This significantly limits sudden panics and collective exits in economic behavior. Yet this discipline comes at a cost. Consumption is restrained, improvements in individual prosperity are felt more slowly, and the system continuously demands high levels of saving. China has consciously chosen to bear this cost, because its priority is not short-term happiness, but long-term resilience. And this leads to the central question: how sustainable is a system built on such extensive control, discipline, and sacrifice? And at what point does it reach its limits? China's economic rise may appear, from the outside, to be the product of a flawless plan. Yet this model has sharp limits as well as undeniable strengths. High savings, tight control, and long-term guidance have stabilized growth, but they have also reduced flexibility. An aging population, domestic consumption failing to grow at the expected pace, and inefficient investments accumulating within the system represent some of the fundamental risks this structure now faces. In particular, the invisible layering of debt may not cause immediate problems, but over time it narrows the room for maneuver. China is aware of this, which is why it constantly attempts to recalibrate the model. Control is never fully abandoned, but it is loosened. The market is never fully liberalized, but it is allowed to breathe more freely. This balancing act is the true test of the Chinese economy, because the methods that have worked so far may not yield the same results under tomorrow's conditions. Global competition, technology conflicts, and geopolitical tensions all increase the cost of financial decisions. China's real achievement lies in its ability to change direction without becoming locked into a single absolute truth. What are often described as financial tricks are, in reality, reflections of a mindset built on patience, discipline, and control. This mindset has turned China into an economic giant. Yet what will keep it standing in the future is its ability to manage change with the same discipline. In the end, the issue is not how fast you grow, but how solid the foundations are while you grow. China's story gains meaning precisely when viewed from this perspective.